Something massive just broke loose in the US auto market. CarMax, the nation's largest used car retailer, has just triggered a price collapse that no one saw coming. Cars that were once listed for $40,000 are now being sold for $15,000, and it's not just a seasonal sale. This is a full-blown market correction that's shaking automakers, dealerships, and even Washington itself. So what exactly happened inside CarMax that's causing this chaos? And why are American automakers suddenly in panic mode? Let's break this down because this story runs far deeper than simple discounts. It's the clearest signal yet that America's auto bubble is bursting. CarMax, once known as the gold standard of the used car market, just did something shocking. They aggressively slashed prices across their nationwide inventory. Vehicles that were previously sitting on lots for months are now being cleared out at record low prices. We're talking about once high-demand SUVs and trucks, Ford F-150s, Toyota Tacomas, Chevy Silverados, now selling for almost half their previous asking price. Why? Because CarMax is facing an inventory overload unlike anything in its history. Their lots are overflowing with used vehicles, trade-ins are piling up, and sales have slowed to a crawl. The company's strategy now is simple but brutal. Cut prices, move inventory, and survive the storm. But what caused this storm in the first place? Well, it's not just CarMax's fault. The entire used car ecosystem is in trouble. Over the past few years, prices skyrocketed due to chip shortages and low new car supply. Now that supply chains are back online, new cars are slowly returning to the market. But here's the problem. Consumers are no longer buying the way they used to. High interest rates have destroyed affordability. A $600 monthly car payment is now a nightmare for the average American family. Banks have tightened lending standards, making it harder for people with average credit to even qualify for a loan. As a result, used cars have started to sit unsold for months. And this slowdown didn't go unnoticed in Washington. The U.S. government, which closely tracks inflation through car prices, is watching the used car collapse with growing concern. The Biden administration knows that falling car prices can help tame inflation numbers, but it also signals something far worse: a cooling economy. Government economists are warning that the used car market may be the canary in the coal mine, a warning sign that consumer spending and confidence are fading fast. Meanwhile, U.S. automakers Ford, GM, Stellantis are panicking. They've built their strategies around inflated vehicle prices and strong demand. Now, with CarMax dumping inventory at fire sale prices, those automakers are being forced to offer massive incentives and rebates on new models just to compete. They can't afford to lose buyers to the used car market, but they also can't keep producing vehicles no one's buying. Production lines are slowing down, plants are idling, and executives are slashing forecasts for 2025. So why exactly is new car production slowing down so dramatically? The answer lies in uncertainty. Automakers are terrified of overproducing vehicles that could end up sitting on a dealer lots for months, just like the used cars at CarMax. Demand for new cars has become unpredictable. Buyers are hesitant, financing costs are high, and electric vehicle sales are stalling. Factories that were once working overtime are now cutting shifts, and suppliers are feeling the ripple effects. It's a domino chain, and CarMax's price collapse might be the first major piece to fall. Buyers, on the other hand, are reacting in two very different ways. On one side, bargain hunters are rushing to CarMax lots to scoop up deals of a lifetime, getting trucks, SUVs, and luxury sedans for prices not seen since 2018. But on the other hand, many buyers are holding back even more, waiting for prices to drop further. Confidence is collapsing. Everyone is realizing that if $40,000 cars can drop to $15,000 in a matter of weeks, then what's the rush to buy now? Dealerships across America are starting to panic too. Smaller independent used car lots can't compete with CarMax's markdowns. Their margins are getting crushed, and some are already shutting down or liquidating inventory at auction. New car dealers, meanwhile, are facing a nightmare scenario. Customers walking in, comparing brand new models to used versions now selling for a fraction of the cost. How can they sell a $50,000 truck when CarMax has a nearly identical one for $20,000? The impact on prices is spreading fast. Analysts are already calling this the biggest correction since 2008. Vehicle values are falling across the board, and this time, it's not temporary. The once booming resale market is now turning into a buyer's market. And that shift could rewrite the entire American auto industry. What we're seeing now might just be the beginning of a massive restructuring in how cars are valued, financed, and sold in the United States. And here's the shocking part: CarMax isn't done yet. Reports suggest they're preparing for another wave of markdowns heading into the winter as they struggle to unload 2023 inventory before the next fiscal quarter. If that happens, we could see another round of price freefall that pushes the entire used car market into uncharted territory. And Wall Street is already smelling blood in the water. Hedge funds and major investors are quietly repositioning, betting that the used car market crash will spill over into new car sales, dealership earnings, and even auto loans. Several large investment firms have started shorting auto lenders like Ally Financial and Capital One, predicting that loan defaults will surge as car values collapse. Think about it. If someone bought a used SUV for $38,000 last year and it's now worth $18,000, they're massively underwater. Many of those loans are subprime, meaning higher risk from the start. Once owners realize their vehicles are worth far less than what they owe, repossessions will skyrocket. And when that happens, even more used cars flood the market, driving prices down further. It's a vicious cycle, and CarMax just lit the match. Inside the automakers' boardrooms, there's growing fear this crash could derail years of planning. Ford's executives are reportedly scrambling to adjust production schedules, cutting back on high-margin pickups and SUVs while delaying several new EV launches. GM, meanwhile, is scaling down its electric rollout and quietly offering unheard-of dealer incentives on gas models just to keep factories moving. Stellantis, the parent of Ram, Jeep, and Dodge, is facing its own nightmare. Thousands of unsold trucks piling up in storage lots, while CarMax slashes used Ram prices by 40%. That makes every new Ram instantly look overpriced. What's worse, the ripple effect is reaching beyond automakers. The slowdown in car production is hitting American manufacturing jobs. Suppliers who make everything from seats to sensors are reporting mass layoffs. Shipping companies that deliver parts are seeing volume drops. Even tire manufacturers and oil suppliers are warning investors of slower demand. What started as a used car price war is now threatening to become an industrial slowdown. Meanwhile, on Main Street, American consumers are confused and frustrated. For the first time in years, they're seeing cars become affordable again, but the fear of losing value is keeping them from buying. The psychological shift is huge. During the pandemic, buyers rushed to pay above sticker price because they were afraid of missing out. Now they're doing the opposite: waiting, watching, and holding cash. Economists call this buyer paralysis, and it's one of the hardest cycles to break. When buyers stop believing in stability, the entire market grinds to a halt, and the government knows this is dangerous territory. Officials from the U.S. Department of Commerce and Treasury are already discussing measures to prevent a full-scale collapse in consumer credit. There's talk of easing auto loan terms, expanding incentives for EV trade-ins, and even pushing automakers to slow down price cuts to avoid deflationary pressure. But there's a catch. The more the government intervenes, the more investors believe the market is too weak to stand on its own. That lack of confidence could send auto stocks into free fall. At the same time, CarMax's competitors are being forced into a corner. AutoNation, DriveTime, and even local dealerships are now matching or beating CarMax's markdowns to stay alive. The result? A nationwide used car price war that's breaking all the traditional rules. We're seeing luxury brands like BMW, Mercedes, and Audi dropping in value faster than mid-range models. Trucks and SUVs, once America's most stable assets, are falling hardest because those high sticker prices are now impossible to justify. But here's the bigger question: is CarMax acting out of desperation, or are they the first to move in a market correction that everyone else is afraid to admit is coming? Some analysts believe CarMax's leadership saw this crash months ago. Instead of waiting for the market to collapse around them, they decided to get ahead of it. Take the hit now, unload inventory, and rebuild leaner for 2025. If that's true, it means other companies like AutoNation and Lithia Motors could be weeks away from following suit. As this unfolds, the impact on financing is becoming even more severe. Lenders are tightening credit approvals, raising down payments, and shortening loan terms. Buyers with anything less than top-tier credit are being shut out of the market entirely. This not only limits sales, but also drives more Americans into the private party market, where prices are collapsing even faster. In other words, the system that once thrived on easy money and inflated values is now choking on its own excess. And yet, the most shocking part might still be ahead. Analysts from Morgan Stanley and Edmunds are warning that if CarMax continues to drop prices through the winter, we could see another 20% to 30% collapse across the entire used car segment by early 2026. That would be catastrophic, not just for automakers, but for banks, leasing companies, and even everyday car owners whose vehicles are rapidly losing value. Imagine millions of Americans waking up to find their cars worth less than half of what they paid just a year or two ago. That's not just a market correction, that's a confidence crisis. And this is where things start to get truly alarming. Because what's unfolding right now isn't just about cars sitting on lot or dealerships slashing prices, it's about the financial backbone of the entire auto industry starting to crack. Behind every vehicle sold at CarMax, there's a web of loans, credit lines, insurance policies, and investor-backed securities. When those vehicle prices collapse, the collateral that supports all those financial products collapses too. And that's exactly what's starting to happen right now. Major auto lenders are quietly panicking. Reports from inside the finance sector reveal that loan delinquencies are spiking, particularly among subprime borrowers who stretched themselves thin during the 2021 to 2023 car boom. Many of those buyers locked into overpriced used vehicles with 9 to 12% interest rates, believing they could refinance later. Now, they're discovering their cars are worth tens of thousands less than their outstanding loans. Repossession lots are overflowing again, echoing the scenes we saw during the 2008 housing collapse. Except this time, it's steel and rubber instead of bricks and mortar. And as repossessed vehicles flood the wholesale market, it creates a secondary shockwave. Auction prices plummet, dealers stop bidding aggressively, and the resale market craters even further. It's a downward spiral that feeds on itself, one that even CarMax may struggle to survive if the cycle continues through winter. Insiders are already whispering that CarMax's aggressive markdowns are not just a strategy, but a last-ditch defense to generate cash flow and avoid sitting on depreciating assets. Meanwhile, the electric vehicle market, which was supposed to be the future, is adding fuel to the fire. EV values are collapsing faster than any other segment. Vehicles like the Ford F-150 Lightning, Tesla Model Y, and Chevy Bolt have seen resale prices plunge by 40% or more in just 12 months. Buyers are realizing that battery degradation, high replacement costs, and an uncertain resale future make used EVs a risky bet. CarMax, which once bet big on electric inventory, is now slashing EV prices more aggressively than any other category, further dragging down the market average. For U.S. automakers, this is becoming a nightmare scenario. Ford, GM, and Stellantis invested billions into electrification, expecting high resale values to support long-term profitability. But with used EVs tanking, lease residuals are collapsing too. That means automakers are losing money every time a leased EV comes back to the lot. Tesla isn't immune either. Its constant price cuts on new models are obliterating the value of its used ones, creating chaos for buyers who thought they were making an investment. The broader economy is now starting to feel the tremors. The Federal Reserve, which has been watching car prices as a key indicator of inflation, now faces a difficult choice: cut rates to support the collapsing auto market, or stay the course and risk pushing the industry into full recession. Every economist knows that when the auto industry slows, it drags the entire economy with it. Manufacturing, logistics, retail, and finance all depend on steady car sales to stay healthy. And right now, everything is slowing at once. In the midst of this storm, American car buyers are realizing something the industry never wanted them to see. The illusion of endless price growth is over. For years, people believed that cars, like houses, would hold or even increase in value. But now that illusion is shattered. The resale bubble has burst, and for the first time in over a decade, depreciation is back with a vengeance. This realization is freezing the market even further because buyers are afraid to commit. Every week they wait, cars get cheaper. Every month, more models drop below new price lows. Dealerships, once overflowing with optimism during the post-pandemic boom, are now quietly liquidating stock and cutting staff. Many are turning to fleet sales, auctions, or even exporting vehicles overseas just to stay afloat. The profit margins that once made the auto industry one of America's most lucrative sectors are evaporating. The golden age of easy sales, inflated values, and record profits might be coming to an end. And CarMax, whether by design or desperation, has become the face of that collapse. But the most chilling part? Industry analysts warn that we're only halfway through this correction. The real impact won't fully hit until early next year when tax refund season fails to bring the usual sales spike. That's when dealerships will face their true reckoning: high interest costs, slow sales, and shrinking credit lines. Some experts predict that by mid-2026, up to 20% of used car dealerships in America could disappear entirely if prices continue to fall at this pace. And through it all, consumers are caught in the middle, torn between excitement over lower prices and fear that the market still hasn't hit bottom. Every buyer waiting on the sidelines adds another layer of pressure to the system, another sign that the collapse hasn't reached its end. Behind the scenes, the panic has reached Washington. Sources close to the auto industry confirm that executives from Ford, GM, Stellantis, and even CarMax have been quietly meeting with federal officials, lobbying for emergency relief measures. They're asking for everything from low-interest financing programs to federal fleet buybacks, essentially a bailout disguised as economic stabilization. The message is clear: if the government doesn't step in soon, the entire auto sector could unravel. These closed-door discussions are happening as automakers brace for a wave of financial pain. Internal forecasts reportedly show profit margins dropping by more than 60% in some divisions. EV plants that cost billions to build are now sitting half idle. And suppliers, the smaller companies that make the nuts, bolts, seats, chips, and dashboards, are warning they can't survive another 6 months of production cuts. The supply chain that powers America's auto industry is fracturing again, but this time it's not because of a global shortage. It's because demand itself has collapsed. At the center of it all, CarMax is trying to spin its crisis as a market adjustment. But insiders know the truth. The company's inventory financing costs have exploded. Every day those cars sit unsold, CarMax pays interest on the floor plan loans that fund their inventory. With interest rates still high, that debt is eating into their profits like acid. The only way out? Sell fast, even if it means taking losses. That's why you're seeing those unbelievable price tags. $40,000 cars now listed for $15,000. Luxury SUVs marked down like clearance items at a department store. It's not marketing, it's survival. The government's reaction so far has been cautious but concerned. Treasury officials acknowledge the used car market collapse could ripple into consumer credit, pushing delinquencies higher and hurting household balance sheets. But there's debate over whether intervention is wise. Some policymakers argue that this correction is necessary, that car prices got too high for too long, and the market is simply normalizing. Others warn that letting the market freefall could drag down GDP growth and trigger job losses across the Midwest, where auto manufacturing remains a lifeline for millions. And let's talk about the EV oversupply crisis that's now colliding headfirst with this downturn. Automakers spent years ramping up EV production to meet ambitious government mandates and corporate promises. But demand has cooled dramatically. Consumers aren't ready. Charging infrastructure is inconsistent. Battery replacements are costly, and resale value is terrible. So now, hundreds of thousands of unsold electric vehicles are sitting in storage lots across the US, costing automakers millions in carrying expenses every single month. CarMax's price crash just made that worse. When buyers see used Teslas and Ford Lightnings selling for half their original price, they start questioning whether EVs are worth the risk at all. That perception shift is devastating for automakers who banked their future on electrification. Suddenly, they're not just fighting falling demand, they're fighting consumer distrust. Wall Street analysts are already warning that this could become the auto sector's Lehman Brothers moment. The auto loan market is massive, over $1.5 trillion in outstanding debt, and much of it has been bundled into securities sold to investors. If those securities start to fail because the underlying car values collapse, the shock could spread through the financial system fast. Think housing crash, but on wheels. Meanwhile, the pressure is building for dealerships on the ground. Independent used car dealers are struggling to compete with CarMax's liquidation-level pricing. Many are dumping their inventory at auction, often at a loss just to keep cash flow alive. New car dealers, on the other hand, are demanding that automakers offer bigger rebates and floor plan assistance. But the manufacturers are already bleeding cash. It's a standoff where everyone's losing money, and no one has a clear escape route. Consumers are now more cautious than ever. They've learned that waiting pays off, that patience means thousands in savings. Every time a buyer delays their purchase, it reinforces the cycle of falling prices.